The markets are currently closed as we sit here on this Sunday, December 7th, 2025. However, to understand the massive coiled spring that is Aurora Innovation Inc., ticker symbol AUR on the Nasdaq, we have to look exactly where the dust settled after Friday's session. The stock closed at $4.46, taking a minor hit of 11 cents or roughly 2.41% on the day. Now, seeing a red number on a screen might make the average retail investor nervous. It might make you think the momentum is dying or that the bears are taking control. But if you stop listening to the noise and start looking at the signal, that $4.46 price tag tells a story that is radically different from the panic selling you see on the forums. Here is the expectation that most people have when they hear about autonomous vehicle stocks, or AVs. They think of robot taxis getting stuck in traffic cones. They think of Tesla stock and the endless promise of next year. They think of a technology that is perpetually 5 years away, something that belongs in a science fiction novel rather than a portfolio. That is the expectation, a cash-burning furnace with no real-world application today. But here is the reality, and this is what should keep you glued to the screen. Aurora Innovation isn't just testing science projects, they are hauling commercial freight right now, with no human in the cab on high-speed highways in Texas. While the market was fretting over a 2% drop on Friday, the company's CEO, Chris Urmson, recently put his money where his mouth is, buying a cool $1 million worth of his own stock. When the guy who built the technology is buying millions of shares at these levels, you have to ask yourself, what does he know that the algorithm trading bots don't? Let's break down this recent price action because it is absolutely fascinating if you enjoy technical setups. We saw Aurora pop nearly 13% just a few days ago, driven by the news of expanding their Texas routes, specifically the lane from Fort Worth to El Paso. That is not a short drive, that is a serious logistical artery. The stock rallied hard, touching highs that we haven't seen in weeks before cooling off this Friday. This pullback to 446 cents isn't a crash, it's a consolidation. It is the market taking a breath after realizing that the timeline for driverless trucking isn't 2030, it's happening in late 2025. The volume we are seeing is telling too. We had over 12 million shares change hands, which shows that institutions are active here. This isn't just retail traders on a Robinhood app throwing darts, this is smart money positioning itself for what they believe is the inevitable shift in logistics. You have to understand the psychology of this specific trade. When you look at stocks like Nvidia stock or even Apple stock, you are looking at companies that have already won. The valuations are sky high and the growth is predictable. Aurora is different. It sits in that uncomfortable valley between proven concept and mass adoption. That is where the tension lies. Investors are terrified of the cash burn, and we will talk about that because burning over $200 million a quarter is not something we can ignore. But they are also terrified of missing the boat on a company that could effectively become the operating system for the entire global supply chain. That tension creates volatility, and volatility creates opportunity for those who are paying attention. Now, before we get into the nuts and bolts of the technology, I want you to consider the broader landscape of online investing and how retail traders are approaching this. Most people using Schwab Intelligent Portfolios or Fidelity investments are typically steered towards safe, diversified funds. They are told to buy the index and go to sleep. And for 90% of your money, that's great advice. But if you are engaging in self-investing or using an individual brokerage to pick specific winners, you are looking for asymmetry. You are looking for a bet where you can lose 1 unit of risk but gain 10 units of reward. Aurora is the definition of that asymmetry. The market is pricing it like it might go bankrupt in 3 years, but the technology is performing like it's going to dominate for 30. Let's talk about that technology because this is where the expectation versus reality gap is widest. The common belief is that all self-driving cars are the same. You put some cameras on a bumper, throw in some AI, and hope it doesn't hit anything. That is the camera-first approach we see in some consumer vehicles. Aurora does not do that. They use a proprietary technology called First Light LiDAR. Imagine a laser that can see perfectly in pitch-black darkness, through rain, and importantly can spot a pedestrian or a stalled car from 450 meters away. That is more than 4 football fields. A human driver cannot do that. A standard camera cannot do that reliably at high-speed highways. This LiDAR is what allows their trucks to drive at 65 miles per hour safely. When you're moving 80,000 pounds of freight, you don't need a system that reacts fast. You need a system that predicts problems 11 seconds before they happen. That is what First Light does. This is why major players like Volvo and Picard, the company that makes Peterbilt and Kenworth trucks, are not just customers, they are deep partners. They are building trucks with Aurora's nervous system integrated directly into the chassis at the factory level. This isn't an aftermarket gadget you glue to the dashboard. This is a fundamental redesign of the semi-truck. And it's not just the truck manufacturers. Uber Freight is booking loads on these trucks. FedEx has been running pilots. The ecosystem is already built. The expectation is that Aurora has to go out and build a trucking company from scratch, buying thousands of trucks and hiring mechanics. The reality is, they don't want to own the trucks. They want to be the driver service. They want to sell the software and the hardware kit, charge a fee per mile, and let the carriers worry about the tires and the oil changes. It's a software-as-a-service model applied to the physical world of atoms and asphalt. This brings us to the financial picture, which is the elephant in the room. If you look at their recent earnings, the numbers can look scary if you don't know what you're looking for. They reported revenue of just over $1 million. For a company valued at several billion, that sounds like a joke. But you have to look at the context. That revenue is starting to trickle in from actual commercial loads. It's proof of concept revenue. The more important number is the liquidity. They have roughly $1.6 billion in cash and equivalents. Based on their current burn rate, they have a runway that extends well into 2027. This is crucial because it bridges the gap between today and the moment they turn the corner to profitability. Many skeptics look at the quarterly losses, over $200 million, and scream, "Sell." They are used to looking at mature companies like those you might find in a standard Fidelity mutual funds portfolio. But if you are using Interactive Brokers or a similar platform to hunt for growth, you know that CapEx-heavy industries always look terrible right before they look amazing. Aurora is building the physical infrastructure, the terminals, the command centers, the high-definition maps that will allow them to scale. Once that network is live, the marginal cost of adding one more truck to the network is tiny, but the revenue from that truck is high margin. That is the J-curve effect that venture capitalists drool over. Let's pause on the market action for a second. Comment below how many shares of Aurora you currently hold, or if you are waiting for a specific price point to enter. I'm curious to see if the sentiment in the comments matches the institutional buying we are seeing. Are you guys bullish on the CEO buying shares, or does the cash burn worry you? Now, let's pivot to the macro environment because stocks do not trade in a vacuum. We have a massive labor shortage in the long-haul trucking industry. Young people do not want to drive trucks for weeks at a time, sleeping in cabs and missing their families. The turnover rate for long-haul trucking fleets is nearly 100% per year. That means for every driver a company hires, another one quits. It is an operational nightmare for companies like Werner or Schneider. This is where Aurora isn't just a cool tech play, it is a deflationary force. If you can take the human out of the cab for the long, boring highway stretches between Dallas and Phoenix, you don't just save money on wages, you break the regulatory limit on hours of service. A human can only drive 11 hours a day. The Aurora driver can drive 24 hours a day, stopping only for fuel. That effectively doubles the utilization of the truck. You are getting 2 trucks for the price of 1. That is the economic reality that will force the industry to adopt this technology, regardless of whether they like robots or not. It is pure economics. However, we must address the risks because I would be doing you a disservice if I painted this as a guaranteed win. This is a high-risk play. If you are doing your own investment help research or looking for investing sites to park your retirement money, you need to know the downsides. Regulation is the biggest wild card. The federal government is still catching up to the technology. If a high-profile accident occurs involving an autonomous truck, even if it's not Aurora's fault, the political backlash could freeze the industry for years. We saw this with the Cruise robot taxi incident in San Francisco. The public trust is fragile. Aurora has been obsessively safety-focused, often delaying launches to ensure safety cases are closed, which is why they are not as famous as Tesla stock in the consumer mind, but they are more respected in the industry. But political risk is real. Then there is the competition. You have Waymo, owned by Alphabet, which is a formidable opponent with deep pockets. You have private companies like Kodiak Robotics doing great work. But Aurora's advantage lies in that specific focus on the driver